there. Oh, God, I realize it's recording. Welcome back to the No Reservations Podcast. This is episode 49. Ooh, 49 of these. Does not feel like it. Feels like 6. Episode 49, and we are calling it Understanding Your Restaurant Numbers Without the Stress. Yeah. Big topic that I'm going to try and break down. No, I'm not going to try. I am going to break this down into very easy to understand metrics. And try not to go off on too many tangents when it comes to this one. But when it comes to restaurant numbers, this is what I do day in and day out. So it's just something that I live and breathe on a regular basis. And I'm seeing the same things over and over and over again. When I speak to new clients or potential clients, leads, referrals we get coming in the door, almost 100% of the time when I get to take a look at their books, I'm seeing the same, what I would consider concerning issues over and over and over again. And not just because their books might be really, really bad, really messy, really behind, really just messed up in every way, which all of that can be true. Not always. Sometimes I see a really clean set of books and I'm shockingly and wonderfully surprised by that. I love when I see that. That's pretty rare. But I'm more talking about even just the organization of your books, of your chart of accounts. So the chart of accounts is a very basic accounting term, and whether that appears on a spreadsheet or in what they call the old green ledger papers, or in your accounting software. Everyone has a chart of accounts, and it literally is just that. It is a chart or a page or pages of listing all of the different accounts that you have, all of the accounts. So some of those accounts are going to be balance sheet accounts, like your checking accounts, your cash, your petty cash, your cash on hand, your safe, whatever you want to call it, your savings accounts, your assets, all the things that are on the top of the balance sheet. And it's going to list out all of those. And it's going to also list out all your liabilities and your accounts payable, not by vendor, just that one bucket. What's in your accounts payable? What are your liabilities, whether it's your sales tax, your meals tax, your payroll tax, your payroll tips, whatever, your equity. So that's, the listing of everything that you see on your balance sheet has, all the accounts of a name, and that's part of your chart of accounts. And the other part is going to be all the things you see on your P&L. So from your income or revenue or sales, whatever you call it, to your cost of goods, to your expenses, and blah, 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 all those are listing. So when I say chart of accounts, everybody's got one, whether you realize it or not. And they can be extremely detailed to not being detailed. That's completely up to you and what makes sense to you and how you want to look at your numbers so that you can understand your business. But even if you have the most detailed set of books, meaning you really like to break things out, and I'm talking about all over the place, but mainly on the P&L, because hopefully you're not going to get too detailed in your balance sheet. Actually, it doesn't really allow you to do that anyway. But on your P&L, if you're talking about you're tracking your fish sales versus your red meat sales versus your salad sales and your chowder sales and down everything. If you're tracking it that detailed, that's could be insane. It is insane, and I can tell you a better way to do that without having to subject your accounting software to that. But you should be breaking out your food sales versus your liquor sales versus your wine sales, your beer sales, your non-alcoholic sales. And I would go as far, if you sell a good amount of non-alcoholic sales, you might want to break those down into coffee, bottled water, maybe mocktails if you have a mocktail menu, break them down, but bigger buckets. Those are the buckets I would highly recommend. But you don't have to go too detailed in those. But also, please don't just have one income account that's called sales and you put everything in there. That's really going to do you no favors. And the other thing that I was working on this week, which is a smoothie place, it's actually a franchise. And they record their sales by how they get them. So they have store sales, Uber Eats sales, DoorDash sales. And I get why that's important. You kind of want to know where the sales are coming from. Like, I get that, but you don't need your chart of accounts to represent that. You can get that information a different way. So I don't love it. I would rather them actually break up their smoothies versus bowls and maybe go a little bit more detailed than that, but not necessarily where it comes from, because the next thing on your P&L after how you break down your revenue is your cost of goods, what it cost you to sell those things. So in my original example, where you have, food, liquor, wine, beer, non-alcoholic beverage for the most part, you'd also want to have the mirroring cost of goods accounts: food cost, liquor cost, beer cost, wine cost, so like that. So you want one versus the other, because that's the simplest, fastest, and easiest way to immediately know what your food cost is, what your liquor cost is, what your wine cost is, etc. So I highly recommend doing that. So that's at the top of your P&L, right? So you're going to have your income in a few different buckets and how you break it down. And then you're going to have the mirroring expense accounts so that you can immediately get those costs. Great. Sometimes the very next thing you'll have is your payroll up there. I'd say it's 50-50, or maybe a little bit less. Some of our restaurant clients, not all, but some keep their payroll up under cost of goods because they use that as their prime cost. And you can absolutely do that. We have a handful that do it, and that's fine. So you want to have that, and you want to have that broken out a little bit, but not too. You don't want every person's name. Let's say, put it that way, because I've seen that, believe it or not. I have seen them actually make a chart of an account for everybody's name. And while that information is good to have, you want to know what you pay people on a weekly, monthly, annual basis. You do not need that on your chart of accounts. There's another way to get that information. But you do want to have it broken down to at least front of the house, back of the house. Owner should be completely separate. So if you're an owner, you want your owner's wages, your owner's pay, your owner's salary, whatever you call it, as a separate line item, as a sub account of your payroll. But it should always be separated. Then front of the house, back of the house. And then I'd go even deeper than that. You'd want to have front of the house management as a sub account. You would want to have maybe back of the house or chef expense. And then you could even go deeper, which I kind of like to see for front of the house. Another sub account would be, hosts, servers, bartenders, maybe barbacks, bussers, food runners. And then, so I highly recommend those sub accounts. And then for back of the house or kitchen, you might want to have, prep cooks, dish, line cooks, sous chefs, something like that. Those are great because you would love to be able to, when you expand and look at your detailed P&L, you'd want to go expand across the months and be able to see, what you paid in every one of those categories. I think that's important because if your payroll's high, and let's face it, most people's is, that's the fastest way to kind of see where you can cut back on. So there's that. So we have that. So we have your sales, we have your cost of goods in terms of food and beverage, and then we've got your payroll. And then beyond all that, you have all of the other expenses that it takes to run your business. And you might have a lot, and that's fine. But when you collapse down, and there is actually a function, collapse, when you collapse down your P&L, you only want to look at 4, maybe 5 header accounts. I call them buckets. You collapse the P&L and you just look at 4 or 5. So I'm actually going to share my screen. If you're driving or you don't have, you're not watching this, that's absolutely fine. Where am I going? Here I am. Because I'm going to describe what I'm saying, and hopefully it should make sense to you. But this is really, really important. So I'm going to show right now what we'd call an expanded P&L. So at the top, I have sales, and then underneath it, food, liquor, wine, beer, beverage, coffee, tea, bottle, like I said, great. And then miscellaneous sales for anything else, merch, whatever else, maybe classes, great. Then that totals up to your total sales, your total revenue, total income, whatever you want to call it. Right underneath that, we have your cost of goods, and then we have cost of goods, and then we have food. And the example I'm showing, another sub account of cost of good food is bread, dairy, grocery, meat, produce, seafood, waste. That's because this particular example that I'm using, they want to keep track of what they're spending in bread, dairy, grocery, meat. And it's and it's a sub account. So I don't always have to look at it. I only will see it when I expand. But it's interesting to have this. I kind of like it because if they know their food cost is high and they're looking for a way to cut back, we can look at the data of what they've spent in bread, dairy, grocery, meat, produce, seafood, etc. across the months and notice if there's been any spikes, anything out of the ordinary. So a good example is you could be looking at this over like maybe the last 6 months. You're like, God, our food costs been up, 3 or 4%. Why is that? And considering if the sales have been somewhat the same overall, and then you see that all of a sudden your meat or your seafood costs, purchases have spiked. They're several hundred to several $1,000s more. And if you know the sales were the same, but yet you're seeing a big increase in those purchases, then you're going to drill in and say, okay, what are the vendors charging me? And then this will tell you to go to the actual invoice and compare what you spent in September to December. And that's where you might notice, oh my God, the price of chicken went up by $2 a pound and my rep didn't tell me. Or shrimp went up by whatever, $5.99, and my rep didn't tell me. And so that's a great place to look versus going right to the vendor invoices, because you might not know what you're looking at. If you just know food costs high, it's a good place to look at vendor invoices, but why not narrow it down? And you can do that via having a really nice, clean, organized chart of accounts. But these, again, should all be sub accounts. You don't want to see this every single time. It's a waste of time to see that, and it'll take away your eyesight, your brain from what you're supposed to be looking at. So that's at the top. We're still at the top of the P&L. That's your cost of goods food. Then we have cost of goods liquor, wine, beer, bottled water, blah, blah, blah. Total cost of goods, and then gross profit, and then under expenses. And once again, what I'm showing you is a bunch of line items. I don't know, 16 line items. We've got advertising and marketing expenses, Facebook, Google ads, print advertising, help wanted, recruitment, charitable donation, comps and discounts, comps for regulars, employee meals and training, owner and manager comps, staff meals and discounts, upset guests, promotional, blah, 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 website expense. All of these are legit organized expenses. You just don't need to look at them all the time. These should all be sub-accounts. All of these could be sub-accounts under your advertising and promotion bucket expense, or it could be under just straight marketing or whatever it makes sense to you. But all of those are just sub-accounts of a much bigger area, which in my example that I'm showing is advertising and promotions. Then the next one we have as the main header account is called direct operating. And all the sub-accounts under there are cleaning supplies, flowers and decorations, knife sharpening, laundry and linen, meals and entertainment, paper and disposables, repairs and maintenance equipment. That's what I have listed under direct operating, because these are also considered kind of controllable. You have control over these for the most part. You have control over using these services, buying these supplies, how you store them, how you treat them, etc. So while all of these line items, cleaning supplies, flowers, knife sharpening, laundry, etc., you want to have them as individual line items, absolutely. They shouldn't be their own line item. They shouldn't be their own header account. The header account is direct operating. After that, we have an admin in general. This is basically your overhead account, your overhead header account, like the bigger bucket. And what goes in here, a good rule of thumb, what goes in here for the most part is anything that you'd still be paying regardless if you had to shut down or not. If you had to close for a week for whatever reason, these expenses for the most part would still be here. So what I have it under here is auto lease. Because if obviously if you lease a car, you could auto lease through the business, gas and mileage, repairs and maintenance, bank service charges, credit card fees. Now that is adjustable, and you wouldn't have those if you weren't open. So that sometimes people put the merchant credit card fees up at the top under cost of goods because it is directly related. I just don't like it up there. I like to keep my food beverage costs clean. So I put it under here, but it does go against what I said because that would go to zero if you had no sales. Finance and interest charges, those would be on loans or credit cards you would still pay. Insurance, of course, you're still going to pay that. Meals and entertainment, office supplies, professional fees like bookkeeping and accounting, consulting, travel, things like that. So admin, that's just administrative. It's the overhead. It's for the officers type thing. So there's a bunch of different things that can go under there, but they don't need their own header account. They all go under admin in general. The next one is one that I'm shocked I don't see being used enough when I'm looking at a restaurant set of books, and it's really, really important to use. Oh, I had to take a drink, sorry. This one is called occupancy costs. It is everything that it takes you to open up the shell of your business. So everything has to do with, like I said, the shell, the building, the space itself. So we have possibly personal property tax that's based on equipment, if you have that, pest control, rent expense, trash removal, repairs and maintenance, building, utilities, all of those things that are just like, the operational shell of the business should go under occupancy because they're all part of that. And you want to be able to see all those as sub-accounts under one header, occupancy, so that you know that that percentage is in line with your business model. Oftentimes, this is where things can really get out of control and really hurt your model. So we want that separated out. And then in what I'm showing on the screen, of course, we have payroll and we have all the different sub-accounts of payroll, like I already mentioned, and then benefits like health insurance, payroll taxes, and there you go. So what I'm showing on screen, I'm 138 rows on an Excel sheet, 138 rows. Now, a couple of those are like, header and total columns. So overall, you get the point. I got over, about 100 different line items on here to track your expenses. However, when you hit the word collapse or condense, or depending on what software you're using, in QuickBooks, it's called collapse. When you collapse, you should only see about 5 different numbers. That's what you want to see. This is going to help you pull the levers and drive your business. So in the example on the screen, I collapsed it down. I had to have a total sales because for this exercise, I don't care what's food and beverage, right? So total sales is 230 grand. Total cost of goods, 29% in this example. That's food, beverage combined. For this reason, as long as I know that my business model says that I need to hit or beat 30% in order for my model to work, and my model meaning to run a profitable business, then I'm good. When I collapse it down and I see that 29, I'm like, okay, I'm good. 30s, 30, I don't want to go above 30. I'm lower. I don't really need to work on that. Could that be better? Maybe, but there's no fire to put out there. So I'm going to move and spend time somewhere else. Then under expenses, we see 5 different header accounts, all with percentages. So I know if one of those percentages is out of whack, that's where I need to spend my time. So the top one I have for this one is advertising and marketing or promotional. So for this example, they had a budget of 2%, and that's what they hit, 2%. The next one down is admin and administrative expenses. We call it admin or overhead. They're at 7%. If in my mind or in my business model, I should be at 5%, then I need to dig in there. I need to drill in, means I need to expand the selection and then start looking at those individual accounts and go, okay, where am I off? Because I'm 2% higher than I should be. Or by the other token, if I have a budget in my business model for 10% for admin, I'm only at 7%, then either great, I'm doing awesome, or something's missing. Did I forget to pay something? Did something not get recorded properly? You want to look into there either way. But hopefully you just did a great job of controlling those. But admin's a little bit harder to control because, again, it's just kind of overhead. The next one down is direct operating. Collapse down, it shows 6%. If in this business, in this example that I'm showing, if their model calls for anywhere between 5 and 10%, say it calls for 8% direct operating, and you're at 6%, then again, great, you beat it. That's awesome. That's amazing, wonderful. You can move on to the next fire, or you could go in and say, all right, let me just make sure this is right, or where can I even cut even more because this, I didn't feel like I suffered in any way. So that's what we want to see. And then the next one down is occupancy at 10%. Spot on. 10% is usually what we kind of go for. 10% is not just rent. And a lot of times, I think people, restaurateurs in general, the restaurant industry, you might hear 10% occupancy and people think just rent. No. Occupancy is rent and utilities and camp fees and pest control and anything else that has to do with taking care of the actual building itself. That's occupancy. So we want all that to be 10% if you can. So that's perfect in my example. And then the last one under here is payroll at 33%. And then when you add, subtract all those together, we have a profit of 13%. So in my example here, this restaurant, their goal is, let's say their goal was a 15% profit margin. Well, they missed it by 2%. So they could look up top and go, okay, where did I lose that 2%? Where can I make it? And in this example, if they're at 33% payroll, they're like, I should be closer to 30 or 31. Well, that's the 2% right there. And that's the work they should go do. Let's figure out payroll. Can we cut back on hours? Did we give out bonuses and we didn't have them, or did we give out bonuses and it shot us up, but we're not going to have to worry about in the next pay period because those are going to be gone, or something. You just want to figure out why you're running at 33% when your business model might call for 30 or 31. Now, on the other end, the reason why I love this collapsed model, and it's so incredibly important to have your financials organized in this way, is because all these numbers need to add up to less than 100%. So there's something left over for profit, right? So if we were running at, 12% in advertising and marketing, well, that just wiped out, another 10 from our profit. So now we'd be at 3% profit and 12% advertising and marketing, and that wouldn't work. So you need to figure out your model. Are there industry norms to know what you should be hitting in advertising, in admin, and direct operating? I mean, there can be. But there's always tweaks because every single restaurant is a little bit different. Some restaurants have their occupancy because they're in a prime, maybe outdoor, beautiful new mall location. And they may be running 15 or 16% occupancy, which is high. And the only way that's okay is if they're able to run really like a lot lower somewhere else. So if we're saying a typical occupancy is 10%, and you're saying, I'm going to be running 16% in this place. Okay, where else are you going to save that 6%? You need to find it somewhere else. Otherwise, it's going to come off your bottom line. And in our example here, if that came off our bottom line, then we're only 7% profit. And is that okay? I don't know, because it depends on what your debt schedule is. Like, do you need to make over 7% profit just to service your debt? Or is that okay with you? Or if not, if you need this profit to service your debt and you still have a 16% occupancy, then it looks like you might have to cut your payroll and get your cost of goods sold down by 3% each in order to cover that. So it's an easier model to look at and to understand where you're leaking the money and where you need to focus your energy and your time and your research and experience on fixing. It makes everything so much easier. Because without being able to have this beautifully collapsed version and only have to look at 5 or 6 numbers and figure out which one's off, if you're looking at this expanded one at all times, and you had percentages there, you're looking at 0.1, 1.2, 2.1, 1.0, 2.6. Over and over and over again, and you're not going to know which one, where you need to spend your time, because everything is going to be a death by 1,000 cuts. 1%, 2%, 3%, 1%. But it doesn't make any sense. So just make sure you have the ability to have a collapsed version in front of you, only looking at, like I said, about 5 numbers, knowing what's too high, knowing where the leak is, and knowing where to spend your time and fix it. So again, I shared the screen. If you're driving or you're not in front of a screen and can't look at it, you might want to go back and pull this up. I think we have them on YouTube. I think that's where we keep them on YouTube. If not, you can always email us and ask us for it. But it's really important to have this. I could actually even send you the Excel sheet if you want to email me on that. We do have a restaurant chart of accounts free download on our site, which is the CaseyAnton.com website. And we have tons of free tools. And one of them is to be able to download in Excel or Google Sheets, I think, but in Excel or CSV, a chart of accounts so that you can just import it into your software. And it's a really good starting place if you're just starting over with a new set of books. All right, so that is a wrap for today. This was episode 49. I hope you took something out of this. Please, please, please leave a review would be huge. That's how we get to expand who we talk to, who we reach, and I would genuinely appreciate it. If you ever want to reach out to us at any time for any reason at all with any questions, you can do so right through the CaseyAnton.com website, sparkbusinessconsulting.com website, or just email us at hello@sparkbusinessconsulting.com. Thanks so much. Have a great day.